It's Tuesday, July 29th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York. Two in Chicago today, Glenn Freiberger and Nick Batista joining us in studio. Welcome, folks. If you're joining us on tastylive.com or the platform Tasty Trade, thanks for joining us. Come over to YouTube. Tell us what you're trading, what you think of this pre-FOMC slumber. Very few shares traded today, gentlemen. Never cleared 1 million contracts on ES, as far as I saw. But it's a day where bonds bounce, gold and silver get a little bit of a lift. The US dollar tries to bottom. The news flow otherwise was fairly quiet, though we do get a US-China trade truce where the can has been kicked down the road 90 days. Nick, I want to go to you first here as we start to look at this market and break open this hour as the futures market closes at 5 Eastern, 4 Central. What do you make of today's light action where we started off overnight, pushing to new highs, only to fail there and close lower on the day?
Yeah, we've done that 2 days in a row, which has been pretty interesting. I mean, we had the Monday open where you had all the, soft tariff headlines where they said tariff deals, and then there was really, kind of no deals. It was a big old nothing burger, and then we sold off into the middle of the day, bounced back at the end of the day to basically be flat. Volumes are abysmal. You're getting a little bit of more of a rotation from some of the big name tech stocks. NVIDIA and the chip sector has been on an absolute tear. Those are unstoppable. You got a bid in Google, which was nice to see because I've been long it, but your Apples, Amazons, Meta, Tesla, not really participating. You got some other huge moves underneath the surface with UNH and some of the other ones. And then, just across the board, I've been getting, everybody's been saying, is this a dispersion trade? Is that what's happening here? It's kind of been that way for the better part of the last 2 or 3 weeks now. It's felt like, every day it's a different group that's up, it's a different group that's down, and it's just a churn and cycle around the circle in that way.
Does that all end?
Well, just quickly, when you say dispersion trade, are you referring to the fact that you're seeing a lot more volatility in individual stocks than you are in the headline indexes at the moment?
Exactly. I mean, you got big moves day to day in single name equities, and then the indices basically go nowhere. The slow grind to the upside. It's the fact that you see, NVIDIA up 3 or 4% on an overnight, move, opens up a couple percent, and the E-minis are basically flat. That's not really what you'd expect. It's kind of like it's getting weighted down by the other parts of the market that are on the downside, obviously, but it's kind of the idea that the single name volatility is way greater, in my opinion, and from what I've been watching, than a 15 VIX would suggest. 15 VIX tells me, you wake up every day and it's, 0.5% move in most of the big name stocks. You're not really getting that. You're getting 3-4% moves to the upside in half of them, 3-4% moves to the downside in the other half. So you're getting these big moves underneath the surface. Nothing moves in the indices themselves.
Glenn, welcome back to the show. It's been a few weeks. Tell me about the world from your point of view here, with risk kind of coming off the board a little bit today. Bitcoin's off a bit, Ethereum's off a bit, the dollar's a bit firmer, stocks are down. How does this all make sense from how you view the world? I know you had some concerns about the next 2 days because it's a jam-packed few days ahead.
Exactly, yeah. I agree with Nick here, but I have to be a little more optimistic that times will be changing, at least from a volatility perspective. I imagine with the next 3 days here, the slate from a data perspective and from an earnings perspective, that the lull days are over. And as soon as tomorrow afternoon, we start to see some movement across these indices and across other asset classes. What do you think, Chris?
It feels like we're pushing on a string up here. I mean, why isn't the market able to run any higher with all this news and information? It's not lost to me that there's usually a pre-FOMC volatility and volume drain from the market.
Right.
And if we think about where we've traded this week, we've kind of bounced around, not too much in the S&P or the NASDAQ, a little bit softer net from the gap open. But NASDAQ here is holding up. It hasn't broken down. I think a lot of people want a reason to take some chips off the table right now. And I think you've learned in recent months that if you're not trading the market and you're an investor, you're best served with just sitting tight no matter what's happening. Because if you're an investor who overreacted in April, you may have been under allocated to equities, at least here in the US for the past few months. So you need a trigger to get people to stop staying long right now. Maybe good news is bad news again, guys. Nick, the GDP report that's coming out tomorrow morning is what kicks things off first. It's our week of abbreviations here: GDP, FOMC, and then of course NFP. GDP Now tracker from Atlanta today was revised higher to 2.9% for the second quarter. And while a lot of that's probably tariff give back, if you will, that's not going to give you a second consecutive quarter where you can then mark this off as recession. Do you think the market is going to be disappointed if we don't have recession data coming down the pipeline, as silly as that sounds, because the Fed won't be able to cut then?
Oh, it's a good angle. I mean, it's so funny because it's like one side is good, one side is bad, right? So you have the recession indicator, which is bad for all intents and purposes, but that means good things. You get to cut rates, and then if you have the non-recession indicator, then you can't cut rates. That's the not cutting is bad. So there's always one of each. I think this will be just like every other, big tech earnings / FOMC week that we've had before, where you have, and it's playing out just like the other ones. You have this event-driven volatility where, everybody's looking at the big name tech stocks. They have earnings. There's some volatility baked into that. You have FOMC, you have GDP, you have all the other 3-letter acronyms going on all week. And you get this little bit of a bit in volatility, which I'm happy to see. I would be more concerned if we were going into tomorrow with vol at lows and the VIX in a 13 handle, or at 1450 or something like that, where we were at earlier today. That would concern me more because that would be complacency. This is kind of good that there's a little bit of fear, which, and by little, I mean very little, considering that the VIX is a skosh off the lows. But it's good to see that, there's a little bit of hedging and liquidating going into these sort of things, because it tells you that, after the event, assuming nothing is so out of line, you probably have a little bit of a relief. And that's kind of been the story for the last couple quarters, despite, the one tariff, season that we had. It's always been, fear into JPOW. JPOW kind of balks or / kicks the can a little bit, or says, exactly what everybody's thinking. And then it's a little bit of a relief rally because you have that, okay, nothing bad happens. Let's move on.
Yeah, not a taco trade, a Paco trade. Powell always chickens out. How about that one?
I like that. He hasn't, though. He hasn't chickened out.
No, he's held the line. But I see a path that isn't as serious as, full-blown recession indicator, and a path to lower rates. I think we're set up from a timeline perspective in a relatively good way, where we have this FOMC meeting first on tomorrow afternoon. Odds are nothing of merit or substance is said. No change in any rates this time. But the next meeting isn't until September. What that will allow, in my mind, is not as much pressure on the rest of this week's inflation, GDP, non-farm numbers. We'll get 2, maybe even 3 more rounds of those numbers before a cut. And so in my mind, we could see slightly softer numbers, not necessarily recessionary warning, but consistent softer numbers that maybe we get some short-term volatility, some short-term drops in equities and other asset classes. But by the time September rolls around, what's already priced in maybe an actual rate cut that is good for equities.
Yeah, I mean, last year the rate cut in September was good for equities because we got to the other side of the growth scare, and then the Fed just poured fuel on the fire. And so the economy was back in an upswing, and then you're providing lower rates. Stocks go to the moon. Bonds melt down because of reflation. One of the technical signs here, Nick, I see today in my little notes that I generated here about the earnings in the market. S&P valuations are now starting to get above .com level era. And you mentioned volatility being low, and I'm trying to be judicious about this, but if we were to just take a look at the trend line here, the S&P really could not get back above its most recent uptrend from the April and the June swing lows. It's been bumping into it the last few days in July as the underside pretty neatly. And then the most recent move off the swing low that we have on June 22nd here, we're starting to find that come under a little bit of pressure. So the uptrend isn't dead yet, but it's downshifting right now. What's from your guys' opinion, Glenn, I want to start with you. If you're going to see a NASDAQ or S&P up 1% tomorrow, what would Powell have had to say for that to occur? What's the buzzword you're looking for to trigger you to go, oh, time to buy? And then vice versa. If you hear this buzzword, it's going to tell you, oh, geez, the Fed's leaving us out to dry here. I got to sell my stocks.
You have to sell your stocks?
Yeah. What are those words for you? What are your triggers?
I think anything, a crazy turn around the positioning for tariff uncertainty, if they change a lot of that outlook in either direction. If you see a buzzword around their shift in focus, I think right now they're looking all eyes on the labor market. If they all of a sudden have some caution for inflationary pressures that isn't already priced in, then I think that could surprise. Other than that, not really expecting too much.
What about if he steps down?
He steps down, yeah. Watch out. I don't know. Are you insta auto liquidating?
I don't think I'm not.
What if he's not wearing a purple tie? What if he picks a color?
Well, he debunked the purple tie. He rained on our parade there.
What?
Yeah, there was a interview that he did a while back now, but somebody asked him about the purple tie, and he was like, "Yeah, I like this tie. I just wear this tie basically every time."
All right, no tie. He quits on the spot.
No tie, rips his shirt open. Yeah, some of the guys on the desk were calling for him, or at least thinking that maybe he kind of mentioned something, or at least gives a little bit of
a nod
to
an early exit.
Yeah,
I'll take your action on that.
You don't think so? You think he fights it to the bitter end, Chris?
If I thought that Powell was going to hint at that he's going to step down before his term ends, then I would be buying the 1 DTE. Let's go to 1 DTE here in gold.
So you're going to gold? You're not going Bitcoin or shorty minis or something?
No.
Straight to the hard stuff.
Yeah.
There's our Powell resign trade. Risk 40 to make $4,960 in a gold call spread.
I like it.
I like it. So 200 points on gold. Gold up 10% minimum.
Oh yeah. Yeah. Gold would clear gold might get up to like $4,000 tomorrow if Powell were to announce he was. I mean, if he were to be fired, that would be the worst case scenario. But yeah, so. Purple tie, time to buy, Nick. No tie, time for stocks to die. Is what you're thinking? Like, Powell just goes up there, listening to Grateful Dead, takes down his speakers.
Yeah, completely unshaven, a little hungover.
It's been
and
real.
Just drops the mic. He's like, "Yeah, you guys are screwed. I'm out."
Grabs the microphone.
Yeah. Okay, so I mean, listen, tomorrow's meeting, no change is expected. It's 2% chance and change right now. The odds for the September cut are moving up. They were 63% a few days ago. We're now peering in closer to 67%. 2 dissents are expected tomorrow as well. Those have been well choreographed, I think, in advance, so it shouldn't surprise anyone. We haven't seen dissents from the Federal Reserve since September 2020 under Powell. So this would be a unique circumstance. They have been a board that's been in lockstep. But I don't think it's a surprise to anyone because we've heard these officials say in recent weeks, if it's been a governor like Bowman, or you've heard from Wash or Waller, right? Current Fed official, former Fed official. If I were at the July meeting, I think we should be cutting rates. So the dissent, don't think is the shocker. I think the conditions that Powell lays out to ultimately see a necessity for the September cut. Because folks, 4.1% unemployment rate, stocks near all-time highs, an economy that's probably growing after the GDP adjustment, we'll call it 2% plus in real terms for the second quarter, but likely rebalancing to a 1.5% level thereafter. That's not the strongest case for an imminent cut, especially if inflation's still sticking near 3%. That to me says gold is good, silver is good. We had a small bounce today, though. I got to say, I'm really concerned about both of these up here. Glenn, starting with you, this is a market that's closely tied to FX, particularly because of the dollar and its outperformance the last few sessions. Do you find gold and silver's strength today in the face of a stronger dollar something that's noteworthy?
I think the most noteworthy part of it is looking at the range where we've been, and that over the short term, regardless what the reaction is, there's more room to run than we've seen earlier this year, where we're checking in at events like this, pressing on all-time highs or just off them. And so here, I'd say, now more than a lot of other times previously this year, it wouldn't surprise me to get a 1% move, a 2% move in gold, and not even yet be at those levels that we were at in just a couple months ago. So,
realistically, we could go down 2% and not touch the late June low, and we could go up 2% and not touch the July high.
So I'd say a lot less pressure on these metal markets to perhaps move more freely. Mm-hmm. Not sure whether the attention will be there or the trade volume, but that's what's interesting to me.
What's holding it there? What's the chop fest here? Gold.
It's Chris Vecchio's call spread on the outsized Powell move.
that's keeping it contained.
Yeah, no, it surprised me. Not too sure. Like you said, maybe it's with that. It's a good sign with some of that VIX pop that people are keeping some exposure up there, but not sure what causes it to fall apart.
And it feels like with those 100+ IVRs a few weeks ago, Nick, people have just been selling calls up here in gold. Mm-hmm. And we can't really make much progress. But at 33.80 and change right now, I think Glenn has a decent point. If we're thinking about gold the rest of this week, you need more than a 2% drop to get down to the June low. You need more than a 2% rise to get to the July high. It's only a 19.2 IVR. Do you look away from this? Do you focus more on single equities? Is this an area of interest for you? Do you play it through GLD, or who cares about gold? We have Bitcoin to trade.
That has had more of my focus, but I do have a position in gold. I've been playing it with iron condors and kind of leaning into these moves. So into the rally that we had in the middle of last week, I took off the put side of an iron condor that I had on a wide iron condor to take advantage of some of this vol. So into the up move, I took off some of the long delta via that short put spread. It lost pretty much all of its value, given that we rallied 150 points in gold. And then into the down move, I actually was not obviously at the bottom, but on Friday last week, I added that put spread back, a new one, a little bit closer at the money. So I'm kind of like scalping between this range, this kind of tight range that we've had in gold with the volatility where it is. It's been, a fun trade. It's been there's been some juice there to squeeze. So it's a tradable thing recently.
Yeah, it has been. I know that Mike and you and Ilya have been doing directionally neutral or even leaning long deltas, but vis-a-vis short put spreads. Mm-hmm. And so the market's staying up and volatility is getting out of it. That's kind of the ideal situation. If you want to be a short put spread, if it goes directionally up, that would work too. But being long calls, right? It's been flashes in where it's like, this looks like a great trade. No, it's not again. Oh, it's a great trade. No, it's not again. Yeah. So it's been more frustrating from my approach than it is for yours, even though has gold done anything?
No, it's at the same price it was a month ago. And that's why it's been, but you've had this, nice two-sided action that allows you to kind of leg out of these positions which is, not something I typically think of doing in gold because gold isn't really a mover. So it's nice to, have that tool in the toolkit right now.
Glenn, let's switch focus to the US dollar here, which for the second consecutive day, it closes above its 50-day moving average. Hello.
Yeah.
Haven't seen you do that all the way since the middle of February.
Seriously.
Something's changing here.
Definitely a reassuring sign here for dollar bulls is just that from a magnitude perspective, we've seen the drops twice as much as any sort of strength back in the dollar. Here now we're not only building on it from the weekend trade news, which in months past we've seen just evaporate by Tuesday. Any positive sign for the dollar over the weekend or on Monday's open. So yeah, we're not only seeing successive days, but we're seeing magnitude of the euro dollar move yesterday to the tune of more than 1%, and just building on that, I think is a very reassuring sign that we haven't seen since, this year at all, because it's just been euro crushing in terms of 2-3% moves and staying where it is, dollar not being able to fight back. So not sure if the slate of events we have this week, it's also, we're still only 200 points away from those highs. So if the data tells the right story, not a ton holding it back from being at those lows, but at least going into these events, building stronger than we've seen in a long time.
Nick, there's got to be some good news for dollar bulls here at these turns in the last few days. Are you playing this?
Yeah, I've been a dollar bull for more than just these last 2 weeks, so I felt the pain. And so I feel sort of vindicated here after the last couple of days. I will say volatility in the euro itself, if you're trading the euro futures, has been relatively high. It's been a great trade just selling upside call spreads kind of around that 119, 118 level. It's, I've had 2 or 3 of them over the last month or so, 2 months maybe, that I've traded in and out of. And so I've been doing that in the euro itself. I've been trading some of the FX products as well, which are starting to come in a little bit today and over the last 2 sessions here. So I've been trading mostly the euro in the futures market and then dabbling in some of the other FX components. But yeah, this move, I've been waiting for this. I could use a little bit more, a couple more days of this.
Very much so. I see a market here that looks like it's ready to turn. The pound right here, 6B on the screen, it's losing the neckline of a potential head and shoulders pattern. The Canadian dollar is losing its uptrend from the low that we had in February, April, mid-July. Likewise, maybe that's a sign of a potential top. The euro already gave way yesterday, and now it's back below the 50, so losing all sorts of support very quickly. By the way, this is one of the largest euro long positions in the futures market ever, for what it's worth.
Oh, that makes me feel so good. That's a contrarian trade.
Yeah, through the end of the week last Tuesday, because the futures reporting period for the COT is Wednesday through Tuesday. So we'll find out the data this coming Friday at 3:30 Eastern. But from the most recent report we just had on Friday, the positioning was continuing to go up. So a lot of people smacked yesterday because it's an exceptionally crowded trade right now.
Yeah.
Glenn, that's why I asked you about gold, because the 3 most crowded trades coming into July were long gold, long Mag 7, and short US dollar. And so there's part of me that sees this turn in the dollar as something that may be problematic for gold and silver to make meaningful advances in the short term. Especially if the dollar is making these kind of moves when yields are coming in, because you as an FX person know the dollar and currencies typically follow rate differentials. And so if the dollar is able to bounce back with lower yields, then what does gold really have? What does silver really have driving it to the upside at that point in time?
Yeah, you bring up a good point, because that's the other variable in this week's slate is
okay.
Yeah.
So, hey, do not resuscitate. Do not resuscitate.
Yeah, we
it-
do have a DNR here.
Yeah,
on-
it's a
fact.
company-wide DNR.
That's good to
You
hear.
come to this
But
place,
only
you work
for
at this.
Glenn.
You,
It's odd.
if you had lights out at this place, that's it. Okay.
I actually am the AED retriever for this office. We have
Are you?
Is that the official name?
Yeah, we have a lot of 60 and above crowd.
Yeah, we do.
They've timed me because the AED's on the first floor, so how fast I could actually get it. 30 seconds if the elevator's working.
Like hazing here.
Seriously. No, but what I was going to say is I'm very interesting to see if we have a correlation breakdown with gold, with yields, just given, what storyline takes over this week. We have our pick of them. And so if it's equity led, does that leave gold out of the picture? Does that present different opportunities? And does the dollar recouple with some of these rate moves? I don't know.
That's one of the odder things today, given the correlation between rates and the dollar in recent weeks, where it's actually tightened back up again and has been behaving quite normally to a certain extent. You don't really see that today. Lower yields, stronger dollar, kind of a buy America view in there. But then you look at gold and that's up and stocks are down. So not a super fantastic mix. Speaking of the mix here today for stocks, the sector performance is pretty evenly split when we look 2-hour sector ETFs here, basically right down the middle. We've tracked 25 here on overtime. I see 10 that are in the green, 2 that are orange, and then you have another 13 that are red. I don't see any significant thematic idea to follow through on here because on one end, retail is performing terribly, the worst performing ETF today, tariff sensitive sector for what it's worth. That's in here off by a whopping 1.69%, but then so too is discretionary and healthcare. On the other end, real estate's up, GDX is up. Nick, you mentioned semiconductors earlier. That's plowing ahead to a new, I guess technically a fresh closing high today. So the AI revolution not dead yet. Do you guys have big concerns about the second half of the week, Glenn? I think that's what you wanted to get into, because for most retail traders, when they think about event risk, or at least the way that they learn how to approach markets, it's kind of like, you may have your methodology. It could be quant, it could be technical, but just be aware when you have these things that pop up. It's an earnings report, if it's a GDP release, they're idiosyncratic risk. Nick, I think that this is a pretty dense time now between the 4 major tech earnings and then all those acronym reports.
Yeah.
Do you find yourself approaching the market differently because we're at all-time highs ahead of this wave of event risk? Are you doing anything unique this week? Any different strategies that you're pulling out? How are you handling it?
I'm playing for a little bit of catch up in the big names that have not participated in the upside. So mainly Apple. I'm also a little bit of long delta in Amazon, but I'm neutral to long. I'm not playing for, I think my view this week is kind of a limited upside with more potential downside. It's almost like a long put spread trade. So I'm playing for a little bit of a catch up to keep a bid in the market in some of those stocks that have been beaten down. Just given where volatility is, where the market is, I'm naturally starting to put on some downside positions, a little bit of a hedge trade. I had this conversation with Mikey of putting on a little bit of short delta doesn't necessarily mean I'm bearish. I'm not bearish to a crash, a 20%, 50%, whatever it is. I don't think that's in the cards, but I think a routine, 4, 5, 6% downside move after what we've seen that brings us back, a month is totally normal and reasonable given where volatility is, given where stocks are, given all the events that are coming up, all the earnings coming up. Even if you call it profit taking, all those things kind of play into a little bit of a pullback at some point here in the near future. So that's where I've kind of started to gravitate towards, and I'm taking off a lot of the stuff that's worked. That volatility is now completely out of those products. When you look at Nvidia at an 11 IV rank, which is kind of up today from where it was yesterday. It was like 5 or 6 yesterday. The stock is a double from the lows. Like, how do you get more long that? Like, if you've been long it, you're taking off delta here. Like, you're not adding more delta. It doesn't mean you're bearish, but it's hard to get more long now after what it's done. And I think there's a lot of stocks where you can paint that story, and that's kind of my thesis for maybe there's a little bit of a pullback.
Is your downside risk plays? Are you playing with the time horizons there? Are you doing anything more short term in that regard because of the week, or is it, like you said, just kind of liquidating some, getting more neutral some?
It's so as you go up and you take off those long delta, like I was trading in gold, that naturally leans you short because you're taking off long delta, right? You're not getting short delta. You're not putting on short delta. You're getting short delta via taking off long delta. And so that's a lot of what I've been doing. The other things I've been looking at are things like QQQ and SPY and doing diagonal spreads or something where you're kind of calendarizing and buying further out premium where, volatility is so low now that
that's exactly what I'm doing.
It's paper cuts for a week or 2 weeks as we grind higher. And then, you get a 1 or 2 point pop in vol and a 0.5% or 1% down move in the market. And those diagonal spreads or calendar spreads, they return you, 30-40% in that one day. Like those are the sort of trades. It's a slow, painful death for 2 weeks. But if you do get that little bit of a down move, it hedges your positions pretty significantly. So that's what I've been looking for. I've been looking for a little bit of a pop in volatility, no huge move, no huge delta. I'm not static delta. It's mostly dynamic delta. It's mostly long volatility, long gamma as well a little bit too. So that's how I'm doing it in the options market.
I've been doing like that synthetic short calendar spread, I guess, where like I'm long the short dated NASDAQ calls and call spreads, and I've been long the longer dated S&P 500 puts, just to think like we're going to keep flying up into the sun. And I don't, I want to be there while we keep going up. And in case the wings melt, then I have some protection in my pocket.
And you leg out of those calls. The shorter term, like you're doing the exact same thing, a little bit different than what I'm thinking is that, because as you get these moves higher, you're taking off those calls, which is reducing your overall long delta. It's getting you more short into these moves. I mean, that's exactly what I've been doing with my positions.
Well, it's certainly I think this is actually a very tough environment to trade, Nick. Like holding on to a bull market while it's melting up on no news and low volume, you kind of start getting into like, okay, something's got to happen here.
Yeah, it's awful. It's been awful for a month. It's been
Can I pose a thought experiment here for us?
Sure.
What if we were to discount all of the price action between April 2nd and May 1st? And we were to just say this is the market rebalancing and dealing with the trade news. But let's envision a world where from April 2nd onwards, the market just chops sideways for the rest of the month. And then in the beginning of May, we start this uptrend. So forget the really aggressive rebound trend from the lows that we have in April. Let's just start from the beginning of May onwards. This is actually a really sturdy, stable uptrend.
We're fine.
Yeah. You get the Men in Black little like pen and just like zap your memory of tariff talks and all that stuff. You can't erase history like that, Chris.
But we have deals now.
But do we? No, we have. Okay, so if we were to follow this path forward, right, and think about how a market correction could unfold, right? Assuming, let's just say the trend stays in place, this listless, everything's fine, we're not going to overreact to tariff headlines. May onwards, this becomes the channel, because I can make an argument. This is 1, 2, 3, 4, 5. There's been a lot of touches in here. We have a correction that lasts a few weeks. Maybe, Nick, you talk about your little pullback here. It brings us right back into the trading range from earlier in July. You get your another leg up into the end of August. You clear 6,700. And you get a ping pong path here where into the end of the year, we can play this game. Nick, you and I have talked about longer term price targets for the end of the year. If everything worked out well and we were to continue the current recovery path that we've been on since May, not that I'm saying we will, 7,000 S&P doesn't seem outrageous,
Ooh.
which comports very neatly with the 1998 scenario that many people are talking about, mainly May. But it would comport very neatly with the 1998 scenario where you get a little bit of chop here for a little while, and then into the middle of August, your chop's been going on for 6 weeks then. You've actually had a market that's been flat from the late June onwards, and you've now cleared the cobwebs. Maybe we've survived a little bit of a volatility bump.
Mm-hmm.
But the uptrends don't look terrible, right? It's only when you measure them from the most extreme point of the low, they look really bad. Otherwise, to me, these just look like channels that have hit channel resistance and are still doing the cadence of a little bit up, a little bit down. You know, we're all friends here. Let's just keep this party going kind of situation. No reason to overreact.
How does your .com level analysis play in here if we keep churning higher? When does that kick in?
Nick, when did the .com bubble burst?
It was after 2000. I mean, was it? I mean, 2000, 2001, but the like worst
March
of it.
2020, I mean, March 2000, we could call it.
Yeah. But it didn't
So if
end
we're
until
talking-
like mid 2001. It went from, I mean, it wasn't like a V bottom.
No, I bring that up because in the analogy, if this is 1998, then that means this could get a lot stupider with valuations.
Okay.
That's my point. I can't go back far enough on the chart. Unfortunately, we only have 20-year look back period. But that's kind of what I'm getting at. Like we're seeing, they're talking about sending out tariff relief checks.
Money printer go burr.
What do you mean we need tariff relief checks?
I mean, emotional compensation, I'll take $1,000.
I'm shaking. I thought the other countries were paying for it. Why do we need rebates on the tariffs then?
That's a good point. I didn't think of it from that angle.
Fine, then I get yours, Chris.
No, I'm not one of those people. You're going to give me the tools to make more money and put more, cheddar cheese on the shelf, then I'm just going to play within the confines of the game.
Yeah.
Begrudgingly, but I'm not going to. I don't like people who fight with one hand behind their back.
Yeah.
There's no moral victories.
Yeah.
So that's why I say, how does this compare?
Glenn, come on,
right.
You're too nice. No
more Mr. Nice Glenn.
Okay, relax. This is only your third time on the show. So we have GDP tomorrow. We have FOMC tomorrow. We have our earnings tomorrow. We got to talk about oil here a little bit. And it's not just because Glenn said he wanted to talk about it, but this is a geopolitical risk situation. President Donald Trump yesterday hinted that he was moving up Russia's 50-day deadline to strike truce with with Ukraine. Okay. Today, Donald Trump formally moved that up to 10 days from now. So I suppose we no longer have a August 1st or an August 12th tariff deadline. We have some amorphous, we're going to punish Russia deadline 10 days out here. So oil prices are going up. It's a 3.72% rally today. The week has seen an explosive move already in very short order. We're talking about nearly 6.5%, 7% now from the lows on Friday to where we are right now. Glenn, your question is, when do we fade this? Nick, I'm glad you're here, but this is usually the Radigan question. It would have been apt for him. He likes to wait a few days, 3 days, 5 days, feels out the situation before he starts thinking about fading geopolitical risk in the market. How do you handle oil here if it is indeed moving for the ascribed reason that I've just suggested?
So I unfortunately not unfortunately, it's fine at the moment, but I am in an iron condor that has a little bit of short delta in oil here, up to like the 71-ish handle. Oil's been a great trade outside of the 1 week kerfuffle we had in the Middle East. It's been a great trade pretty much all year long. So that's been kind of something that I have. So I am in it right now. I guess if it's so easy to say, oh yeah, I'll wait the 3 days. And then if you miss it, you feel like an idiot. I I think at this point, if you are looking at getting some short delta, I would probably consider doing a call spread. Maybe you go a little bit further out of the money, just size it a little bit smaller. And if this continues for 3 more days, you have more ammo to get into those positions. But it's hard to say, I'm going to wait. Like I would love to wait for, the pop and vol to start, getting into some of my positions, but you can't wait around.
Legging in.
Yeah, you stay small and you get some now, and you have the ammo to reload if it continues, and then you don't miss the downside.
That was Josh Fabian's point of view today. He sat in on Futures Power Hour.
God, that makes me sick. Oh, shit. Oh, man.
Back to the drawing board.
So before we immediately lose money on this, I do think that, to your point and Josh's, there is merit to that move. I'm still sitting in my short iron condor, which I'm perfectly content with because there's 50 days to expiration, even as uncomfortable today was.
Mm-hmm.
I'm looking at what a decent trade setup would be to try to size up a short call spread if I wanted to leg into something. And I got to say, Nick, at these levels here, I'm not loving it as today or tomorrow even being the day to start legging in. Because if I wanted to get something in that 60 to 70% profit, I still got to do a 4-to-1 here.
You're not getting the pop in volatility yet. So you've got,
not yet.
In oil volatility has gone from like, let's call it, 33-ish. It's sitting at 38% right now, which is still pretty high. I mean, it's on the higher end of where we've been. It's more towards like the middle. It's not quite the higher end of the 40, 50 IV that we saw, kind of in the tail end of the Middle Eastern conflict move. So if you think, that like in Dylan's mind, to give Dylan his props, that move, if this happens for another 2 days or there's more kind of development in this situation, that's probably going to be the perfect spot if that happens.
Is this not a validation though for a directional bias like that? If we aren't seeing the pop in volatility, maybe you're not getting paid as much for it, but better to be right.
You're saying you get the down move afterwards, like because
Right.
it's all over, like you're not getting the fear, like this is just kind of a short-term thing.
Maybe not.
I respect that.
But yeah, in my mind, at least this does give you a place to look on a Tuesday where everything else is pretty subdued and requires a lot more, perhaps, conviction. Here, you're on a completely different clock if you elect to play on the tariff, or what is it? It would be sanctions shot clock of 10 more days to play nice. So
this is inflation too.
Yeah, we got what, PCE on Thursday?
Yeah.
So
That's another part of this, right? If this was an inflation move, I would think that we'd see it more in the long end of the curve, right? Where the inflation expectations reside. And so if oil's going up and bond yields are down the way that they are today, the dollar and the yen are two of the top performers, makes me feel less inflation worry pass through and more about like this is geopolitics and people are trying to get some safety in their pocket. Nick, you mentioned something about this, selling a call spread here. What if people want to play it both ways? Could they have the best of both worlds by, would you call it like a synthetic covered call? You're buying maybe MCL and selling a call spread in CL here. Sure. Is that something that you find interesting?
Yeah, it's a Mikey Butler favorite. You get the benefits of having a little bit of static delta to the upside. And then with the call spread, you have that short volatility component. And you can kind of manage them dynamically. And because of the span margining, there's relief on both those positions. They're very big positions that you can get kind of, that are reasonably, your capital outlay is reasonable, even in a smaller size account. So definitely, I certainly think that's an interesting way to trade this. Yes, for sure.
Like a bull call ladder, basically. To just cap your upside risk if this thing keeps squeezing, and if it goes up a little bit more and then we start to teeter out,
you can hit on both.
You can hit on both. You take off the MCL long and you let the short call spread ride a little bit.
Yep.
maybe that's how you leg into it, right?
Mhm.
You're selling the call spread, and that way, if this thing keeps rallying, you got something in your pocket. And if you have to adjust your strikes on the short call spread side, it's offset by the gains you have in MCL.
Yeah.
I'm not personally trading this long. I'm looking for that Radigan approach, Glenn, to answer the question that you passed me over Teams. Would I sell this year now, basically, or when would I start to try to fade the move? I think it's going to be a move worth fading. Let's just game this out. Trump's threatening Russia, a nuclear armed state. Are we going to go to war with Russia over Ukraine? Probably not. We're already 2 years in, but are we going to see American boots on the ground? Right? Even Trump with Iran, that was escalate to de-escalate. So we're talking sanctions. That probably makes people uncomfortable going after the Greek shadow fleet, or maybe even pass-throughs with India and preventing India from, well, does that hurt a trade deal? There's so many layers to this. The point is, like, realistically, are we going to see more kinetic war than what we're seeing right now? And I don't mean to downplay the death and destruction, because I feel like the Russia-Ukraine war has been swept into the background as people's attention has been focused more on Israel-Gaza in recent weeks again. But you just search Kyiv or Odessa in the news, and you're going to see that Russia is still sending waves of drones and missiles into major urban areas every single night. So, I mean, are we going to talk about nuclear war? Is that what we're really worried about and pricing in right now? What's also interesting here is this move higher in oil. You see how much energy that the EU says that they're going to buy from the United States?
Was it 700?
Yeah, 50.
700. Did you guys know that if we were to sell that much energy to the EU, we actually don't produce that much energy?
No.
Well, there's no timeline. Yeah. Damn. Who gave
Nobody
you the wrong
thought
numbers?
about that, and everyone was happy. You had to think about
guys.
it.
We would have to stop selling oil to everyone else that we sell oil to satisfy Europe's demand for what it's worth. So either that's not happening, or we're about to drill, baby, drill. Which, again, could we do that? Well, we just put all those tariffs on copper, steel, and aluminum, which makes buying drilling equipment that much more expensive. So what's the path here for oil? Let's just say Trump gets his way. We sell $750 billion worth of energy, bless you, to the EU every year. And we still maintain all of our relationships otherwise. We're going to have to double our oil output. How is that going to impact? So, okay, where's the upside right now? What's the upside shot? You got to tell me. I don't see it unless World War III. But even then, we always fade World War III, because if our counterparties get nuked, we're never going to collect on our debts. So might as well fade the action.
I'm with you.
Glenn, does that suffice? Wait 2 to 3 more days?
That suffices.
Glenn's not calling for nuclear war over here, okay? He's not trying
It wasn't on my bingo card, but
Yeah,
now it is.
Yeah, well, he's no longer a Glenn guy or whatever we're saying, a good Glenn.
Yeah, good Glenn.
So-
He's a bad boy. He's a bad boy, naughty boy. He was just in Amsterdam for a little while.
I was.
Yeah. He's been telling me some stories. He's naughty.
But we're back.
Yeah.
American Glenn is an Eagle
American
Scout.
Glenn.
Yeah, yes.
You really like the Strupen waffle over there, don't you?
Oh, yeah.
That's why you went.
The Bitterballen?
Yes.
Yeah, good. That's usually why people go to the red light district, Glenn.
Mm-hmm.
Here in gold, we saw the breakdown before, and in silver. We've covered commodities a little bit as well as we go into the end of the session. Okay, 5 minutes left. Topic of the day choice, perhaps. What do you guys want to discuss about here into the end? Glenn, you first. Pick Nick's brain.
Oh, gosh. Talk about a dark place. Let's see here. I mean,
I've never been to Amsterdam. I don't have those same memories.
I mean, Nick, are you doing anything in the bond space, or is that not your cup of tea? If not, then what are you thinking about earnings tomorrow?
I have had a small long bond position. I got out of half of it today. I'm long ZBs at the 113 handle. So I am long bonds. And it's been a pain trade for the the last week, and now I'm taking about half of it off at a scratch and, lightening up the position. So I'm there. So I'm not as long bonds. For their earnings, I told you I like the stuff that isn't sitting at highs. I like Apple. I like Amazon. They're not the sexiest, but I think there's a catch-up trade. You saw it in Google. Google, everybody, it's left for dead. Search is dead. Google's dead. And then, there's a little bit of a relief that, maybe Google's not dead. And we can, bid this thing a little bit higher. I think earnings as a whole are going to be bigger moves to the downside. The up moves are going to be very much inside and up. So I think skewing your risk with a little bit of short delta makes sense. That's why I'm hedging, a lot of my positions with the ETFs and SPY and the Qs. That's kind of where I'm getting my short delta and stuff that I'm not playing directly for earnings.
Chris, what about you? What's your where's your eye at?
I'm trying to think of the absolute best and worst case scenarios for the market over the next few days. And obviously earnings matters a lot. Maybe earnings matters more than the GDP data and the non-farm payrolls data. Maybe because of the tariff give back, people don't care about GDP, even if it's going to look good. And we want for the more timely non-farm payrolls reading because that's July and that's third quarter data. I said it earlier, there are some times when I have pound the table conviction and, I'm sending texts to Radigan and Ilya, like blindly screaming by, this is an apeshit moment, buy the dip. And I'm pounding the table and I'm just long ES futures. Forget being long MES or just an ES call spread. I'm just long ES. I have zero gradients right now in that direction. I feel very strongly that this market we are Icarus flying into the sun. But it takes 8 minutes for sunlight to reach Earth from the sun. It's hundreds, millions of miles, right? So maybe it's going to take a little bit longer for these wings to melt because the past 2 years, this has been an economy that's been so resilient. Where's our recession thanks to the Russian invasion of Ukraine and the ensuing Fed rate hikes? Where's the recession from all the end of the COVID era spending? Where's the recession? It never came. It happened in some places, but not for the broader economy. Maybe we're just muddling through. And if we're just muddling through, is that bad for corporate earnings? Probably not. Are people stressed and overextended? Yeah. But as long as the checks keep coming in, then debt can be serviced and the music can keep playing in the short term.
Where are you keeping it really short term? GDP tomorrow morning. That's the next thing on the docket. Where are you looking for a reaction? Are you looking?
I want to see core GDP. Well, first off, I want to see the core GDP figure.
Okay.
Core GDP would be stripping away government spending and the import exports. So we're basically isolating what the private sector is up to. And that was strong in the first quarter. The underlying rate of growth was close to 3% in core GDP, which is one of the reasons why I was like, this isn't a big deal. It looks like it's tracking closer to 0.8 to 1% right now. And that would be a meaningful deceleration that would raise eyebrows. So you could have a scenario tomorrow morning where GDP is close to 3%, but core is 1%. And people think, you hear of administration officials talking about panicins and people that were chickening out in April, when in reality, the market's going to see it and go, oh, geez, this isn't good. And the Fed's not going to cut today. And now all of a sudden we are on a deceleration path and no help's around the corner. So that would be bad news. I want core GDP. I need that to be high. That's the gravy. If we have core GDP up, then everything else the rest of the week probably doesn't hurt on the macro side. Otherwise, macro is going to be a little bit more intense. But you know what? We're ending down the show here today. We learned a few things, including that Glenn apparently travels abroad to Amsterdam, and Tom has some interesting Instagram habits.
Yes.
But with that, overtime is out of time. I want to thank Nick and Glenn for sitting in. Tomorrow, Ilya and Dylan will both be back. I may not be here because this dang attic has got to be cracked open and they got to pull this air handler out. So I stopped sweating in here.
Good
and
luck.
that's right above my office. So until then, good luck trading. See everyone soon. Up next, more Tasty Live. Stick around. Yeah.
churn in the financial markets continues. There does seem to be a little bit of an unclenching in risk sentiment. Bonds up, stocks up, the U.S. dollar idling. That follows some perhaps, maybe, possibly moderating rhetoric out of the White House. But the upshot of the situation broadly unchanged, and the key markets still at key decision points from the beginning of this month. And we'll have to figure out what the price action is going to tell us about that. So in the meantime, we are going to take a look at a broader view of what may be going on here and get back to our conversation about the diminishing confidence in the U.S. dollar, or so it would seem. We talked about why the current environment has been so negative for the U.S. dollar, as we've seen a kind of sell everything U.S. related kind of a dynamic since the beginning of this month. We've obviously seen stocks go down in the U.S., bonds go down in the U.S., and the dollar go down all at the same time in what has been a little bit of a change of pace, the dollar seemingly losing its capacity to rally as a haven on risk-off momentum or on higher yields. Those yields, of course, going up for the wrong reasons, but nevertheless. And so it bears asking, well, if not the dollar, then where? And if the currency world is not through its readjustment on the dollar, then where is there more room for this to continue? So we'll start this conversation here with a relationship that really illustrates why the dollar probably has more room to go down, even as we consider a kind of maybe preliminary unclenching of the issues that we've seen sort of hit the headlines and break out into markets. So this is a chart from the American Enterprise Institute, and it nicely distills what is the relationship between the U.S. trade deficit, ostensibly the thing we're trying to defeat with these tariffs, and its actual implications for what happens with the U.S. economy, and consider that actually what this is effectively a benefit and not a cost. And so consider here that what happens when this trade deficit is incurred, and that's the light blue line here, what is essentially occurring here is an outflow of dollars into the hands of foreigners. And that sounds bad, but consider actually what we're saying. Foreigners end up with a bunch of dollars having sold Americans primarily goods. That's generally where most American imports are. We take care of our services demand via domestic firms for the most part. So, and we're net exporters of services, actually. So on the goods side, we're, of course, net importers by a long mile. And what that does, because clearly nobody's getting on a plane to buy their made in China or made in wherever stuff, they're buying it at their local store here in the U.S. So foreigners, and of course they end up paying for it in dollars. So we're simplifying supply chains for the benefit of the conversation, but the upshot here is foreigners then end up with a giant pile of dollars. And the question then becomes, well, do you convert those dollars back into local currency and invest in your own economy, or do you keep it in dollars? And what has been happening, basically going all the way back to the dawn of this system, which follows the untethering of the dollar from gold in the early to mid 70s, is this idea and this understanding on the part of our trading partners that if they were to convert that pile of dollars in size back into their local currency and repatriate that money, what would happen is the dollar would, of course, fall, because that would amount to selling dollars. Well, and then the purchasing power of their consumers in the U.S. would go with the dollar, and they wouldn't be able to buy all those exports anymore, not nearly in the same size or volume. And so what has happened is a recycling of dollars back into U.S. financial assets. That, of course, is a huge benefit for the U.S. because, number one, it is a huge inflow of capital into U.S. equity markets, which helps finance U.S. corporates. Number two, it is a huge inflow into U.S. Treasury securities, which helps keep interest rates low for the government and for all of the consumer lending rates and business lending rates that use treasuries and treasury yields as benchmark, which, surprise, surprise, is nearly all of them. So what you're looking at then is the upshot of the current account deficit being cheaper U.S. borrowing costs, higher U.S. stock markets, better capitalized U.S. corporates. And of course, since most pension money is basically just market tracking the S&P 500, that's a benefit for everybody involved, even for, let's say, public sector pension holders. Indeed, the largest holder of U.S. equities is CalPERS, the California fund that manages the money of public sector pensioners. So you have a situation here where the halving of the trade deficit, that is more open commerce, and the thing that we're attempting ostensibly to fix, as a mechanism for putting dollars in the hands of foreigners that they then reinvest in the U.S., that, of course, makes the U.S. dollar stronger. Now, lest you say, well, this is only through 2015, a decade has elapsed since, surely this situation has changed. Well, not so much. Here is a view that updates at least the trajectory, and of course these are different magnitude things because we're not dumping all of the sums that are embedded here into this. We're just looking at the direction of travel for the theme. And you can see here U.S. foreign direct investment since the end of the pandemic has surged, which of course has been finding a mirror image in a widening U.S. current account deficit. Not surprisingly, of course, the U.S. economy has been the one that has grown most robustly of the majors. We've seen that time and time again, and you can see that again more recently. More foreign direct investment, even just in the past several years, and a steeper trade deficit. You might take issue and say, well, look, these magnitudes are different. This is some sort of chart art situation. Does this really hold? Well, again, these are not full aggregates. They're meant to show not the perfect relationship, but the trajectory of the theme. But let's take a look at the latest numbers from the U.S. Treasury Department and take a look at the sheer size of foreign holdings of U.S. securities, be it short-term debt or long-term debt or equities. And consider that this is in the trillions of dollars. So we're looking at somewhere in the neighborhood of approaching $30 trillion. Let's be generous and say it's somewhere between 25 and 28, something like this. And you can see that these numbers have steadily grown. And indeed, since the pandemic, they have actually become more dramatic, which of course is exactly what we find right here. So the essence of the relationship very much holds. And so it should not be any kind of a surprise that since the beginning of the year, as we were about to get an administration that very clearly presented itself as minded to close the trade deficit and to become generally more protectionist, that what you would see is a situation where the US dollar would weaken, because if you reduce volumes of trade, be it with tariffs, be it some other way, of course, in this case, it is tariffs. If you reduce the volume of trade, then you reduce the amount of dollars that foreigners hold. And then this dynamic starts to cave in on itself. If they have fewer dollars, then they have fewer dollars to reinvest. If you give them a reason to be concerned about reinvesting those dollars, then maybe they will be more inclined, especially if they anticipate that volumes of trade downwind are going to be reduced and there's less of a reason to want to keep the dollar uplifted for purchasing power of your exports, because what the U.S. has done is basically blocked those exports before that's even a consideration. Well, then you might have an exodus out of the U.S. dollar. And indeed, as we see here, this is a chart of the U.S. dollar index, which is an average of the U.S. dollar's value against its major counterparts. And needless to say, I've decried the limitations of this thing because it was constructed before there was a euro. And so all of the legacy currencies that used to make this a diversified basket are now essentially the euro, and this might as well be then the euro-US dollar exchange rate upside down. The basket doesn't include a China proxy like the Australian dollar, which at this point is the fourth most actively traded currency, according to the most recent data from the Bank of International Settlements, which we'll take a look at in just a second. But nevertheless, the thematic implications of what's going on here, those hold. The upshot of saying to the markets that we are going to try to close the U.S. trade deficit, and the way that we're going to do it is we're going to erect trade barriers that make it less attractive to buy from abroad. That's going to weaken the dollar. And the reason it's going to weaken the dollar is because this recycling of dollars from the trade deficit back into the U.S., that sort of process will be fundamentally undermined by trying to close the avenue by which foreigners end up with those dollars in the first place. And then, of course, comes the question, well, okay, so what then is the next step, and which currencies might you then expect to benefit? Because, again, that money has to go somewhere. Things are still going to be sold, but maybe there's not a reason to dump them back into U.S. markets, and maybe the volumes are less U.S. versus rest of world, but rest of world still has its wares to sell. And so capital is going to go, it's just not going to go into the U.S. So then which currencies ought to be the beneficiaries if the dollar is going to lose some of its quote-unquote market share? And as promised, here are the latest numbers from the Bank of International Settlements. They are as of 2022. That's the last update. They're on a triannual schedule, so we should get another update of these numbers this year. But as it stands, this is where we are, and these things are not terribly volatile, so this is still quite an accurate reflection of current reality. And you can see that the next most liquid currencies after the dollar are the euro and the yen. And of course, we can see the drop-off is absolutely staggering. And lest you think that the BRICS, which I've made into a grouping here, lest you think they're in contention, just consider how absolutely minute they are relative to the amount of monetary transactions settled in the dollars, and also consider that they are just a touch above only China by itself. So really, this BRICS number minus China is barely a rounding error and barely even visible on this chart. I mean, here's Brazil, here's Russia, India is over here, and China's right there. So we're talking about barely visible amounts of volume. And this is not really a contender. There is no way that you could shove anything like a meaningful amount of US dollar market share in terms of settlement payments into this. Now, when you combine the euro and the yen, you're looking at about 3.5 trillion. That's to the US dollars 6.6. So it's about half. So you might see, let's say, this big share of the dollar diminished down, let's suppose, halfway. Maybe, I mean, that would be catastrophic, of course, but let's say you could have room to reduce this by some measure, where the US would be still overwhelmingly the dominant, because there's nothing even remotely close in terms of market size and liquidity and stock of assets to absorb all of this kind of liquidity. But you might perhaps see the tally here come down a bit and the tally here come up a bit. And of course, the problem with expecting the China tally to come up a bit is they don't have markets that are entirely open or even close to open. There are significant capital controls. Liquidity is non-existent in sort of any kind of practical sense, and it'll take a really long time to start to rival the U.S. in terms of financial heft, even though the economy is the world's second largest, just because of the way that capital is gated onshore. And so you're looking at the liquid alternatives where capital can move freely. And needless to say, the natural kind of alternatives that stand out are the euro and the yen. And with that in mind, it seems hardly surprising that those have been the two currencies that have outperformed against the dollar since the beginning of the year. These are percent change numbers for the benchmark futures for the top four currencies most transacted against the dollar. And you can see here it's euro, yen, pound. China's capital controls take it out of rotation. The next one is the Aussie. And those are the four that you see here. We can see the Aussie has lagged. The pound has lagged. The euro and yen have added north of 10% apiece. You might say, well, why are we talking about this now? There's already been a massive rally in these currencies against the dollar. And if anything, they're starting to pull back a bit. We were looking at gains of as much as 12% only a few days ago. Isn't this move over? Well, in my mind, that's the perfect time to be talking about this, because if there is some sort of a near-term correction in this, then what it offers is an excellent buying opportunity. And the time to think about it isn't when that buying opportunity has already appeared. It's when you anticipate and you can prepare for it to actually show up and have the capital and the key levels in mind to actually make that into an actionable thesis. Because indeed, this is not the kind of thing where the dollar sells off because maybe President Trump is going to attempt an extrajudicial firing of Chair Powell. This is not the kind of thing where you get an episodic response to maybe a trade deal with China, maybe not, depends on who you ask. If you ask Treasury Secretary Scott Bessent, a deal is inevitable. If you ask Chinese officials that commented overnight, nobody's talking to them and there is no substantive discussion and they have no idea what the White House is talking about. Obviously, we take both things with a grain of salt. It's a negotiation between rivals. They're attempting to paint the tape their way. So as we look at all of this, the upshot is, beyond these headlines, is there a structural direction? And I think clearly, as we see from the trajectory of the dollar going all the way to the beginning of the year, there indeed is. And we've gone up and down along the way here, but the trend is the trend. And what it reflects is this structural unwinding of these dynamics. And so while the dollar may be done falling here in the near term, the trend remains and the structural underpinnings for it continue. In the most sort of hands-on practical sense, we still are looking at sizable interest rate cuts for the U.S. this year and next, looking at about 110 basis points at this point. Cumulatively, not surprisingly, that tally has increased significantly since all of this concern around the tariff rollout has hit fever pitch late February, let's say, up through now. The expectations have become increasingly more dovish. But against that backdrop, the situation in Europe is quite different. First off, we're looking at less of a tally, so less by about a rate cut than what we have for the U.S. But more importantly, theme-wise, we are starting to see over the recent months, really since the beginning of the year, the idea percolate that maybe next year is a year for rate hikes out of the Eurozone, which would only make the U.S. dollar weakness argument stronger. Because, of course, then yield differentials in a very classic way would shift against the dollar. And this idea that maybe we're looking at rate hikes next year, this follows Europe's seeming conclusion that the U.S. security blanket is now unreliable and that NATO ex-U.S. needs to arm itself. And so there's been a dramatic push, especially in the Eurozone, to spend a bunch of money to rearm. That, of course, is going to be a boost to both growth and inflation, and the ECB is going to have to approach it as such. And so we've seen a sense show up here that the sort of rate differential that maybe favored the U.S. dollar this year, however ineffectively, will actually invert on it next year. That, of course, is something markets might front run as the dust settles. And, of course, for the Bank of Japan, the story uniquely amongst the major economies has been of rate hikes. We can see on the bottom here the spread between the current implied futures curve, that's in the red here. It was a little bit more hawkish a month ago, but nevertheless, it still points to hikes. We can see the difference going into the back half of this year between the current target rate and what the curve implies is positive. That is to say, we are looking at rate hikes into the back half of this year from the Bank of Japan, and that really should be something that makes quite a bit of sense if you consider that we just got PMI numbers this week out of Japan that, unlike many of the other major economies, were blisteringly strong. And so the argument here still seems to favor a U.S. dollar that weakens as U.S. trade policy gets more protectionist, and the euro and yen as the likely winners from that for months and quarters to come, if not perhaps just right here. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'll be back with Chris for Futures Power Hour tomorrow, back with Victor and Tom for First Call on Sunday, writing for the News and Insights portion of tastylive.com, opining at Ilyas Pivac on the platform formerly known as Twitter, and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back next week. Happy trading.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
The beauty of Thinkorswim was that we were different.
From the name to the front-end technology was clearly what we wanted as traders. Second time around, I think we did a better job. Yes, we are known for our ability to support complex derivatives traders, but we also have the tools for somebody who's brand new who wants to come in on the first floor and work their way up to the top of the building.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
To be so powerful and so valuable, and then to be that approachable, just amazing.
Where else are you going to be able to email a CEO, get response back? But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts, some people say it's insane. You know, that's what I do.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number one for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than Boom! Trade like a trader. Tasty Trade. Make your move. You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new Tasty Trade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? Tasty Trade. Make your move.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
To be so powerful and so valuable, and then to be that approachable, just amazing.
Where else are you going to be able to email a CEO, get response back? But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts, some people say it's insane. You know, that's what I do.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're #1 for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
What is going on, everybody, and welcome back to Risk and Reward. We're back with Ian Gus. Got a new risk of the week. We got a lot to get into this week, brother. We got a lot of movement going on. Eli Lilly, Google, Meta, Microsoft, Apple. A lot of earnings, a lot of binary events. How are we holding up so far in the middle of the week?
Yeah, I was ready for the earnings to be what brought on the volatility this week, but the pharma sector is experiencing some
a lot of volatility, no doubt.
Yeah. A lot of things happening there. It's interesting. It's like there's all of a sudden this giant competition for all these weight loss drugs, and everybody is just they're all hurting each other. Like everybody, yeah. Now all of a sudden was it a bubble? Were weight loss drugs a bubble? I don't know. But yeah, doing pretty well. It's been a rough week for me in the market, but fine week personally. You know, this shit ain't everything. So
I hear you.
Yeah, feeling pretty good. You guys had us laughing in chat before we hopped on here. Funny stuff going on. Good to see everybody. Emmett, Grumpy, Luis, what's up? Big deal. What's up? Edward.
What's going on, guys? How we doing today, guys? Hope we're doing well. We got another earnings week, and is there any specific before we get into the details? Is there anything that's sticking out like a sore thumb for you? And if you guys are looking at anything, let us know what you're trading, what you're looking at. I got my eyes on Meta, some other names I want to look at. Anything in particular for you?
Yeah, I would say broadly with these tech stocks, I'm mainly looking to see if this momentum can be sustained.
Right.
All tech stocks have just been on such a rip to the upside since the Liberation Day lows,
Right.
and only continue. And so it seems like for all of these companies, Microsoft, Meta, Amazon, Apple, all these companies having earnings this week, it's going to take some pretty big beats. I feel like I think we might be one of these situations where we're pricing in a little bit too much, or there's too much complacency in the market, and we could see things return to the downside. I don't know if there's anything I'm going to necessarily play myself, but I am hoping we get some of those downside moves to present some buying opportunities.
Yeah, I mean, we can go ahead and jump into the slides here because to dive right into it, I mean, my position was based on a little bit of the fact that we've ripped 5 consecutive weeks to the upside, Gus, to the point you made with Liberation Day. So market's been rallying, not good for my NVIDIA position that I put on a few weeks back for one of the risks of the week. Still holding on. So that's not going on the tally, not on the chart yet. Still got some time on there left, but we can jump into the slides, get into the risk of the week.
The slide deck that I just copied from was like 6 weeks old, and it was your Disney position that expired on the 18th of this month. And so it's been like, that was like 6 weeks ago. You've been trying to get short against this market for a long time.
I think it was
You've moved across the country and just continued trying to get short on the market.
Bro, it's because I came over here and it's humid too. Like, I think I need a change of climate. No, but we'll get into these slides here. Let me make sure I can have great view. Awesome. Risk of the week plus catalyst of the week. Gus, what do you got for risk of the week? What are you feeling this week?
Yeah, I'm going Novo Nordisk. Rare risk of the week, where I actually have outlined 2 different positions that I'm in here. One of them being shares with no time horizon, and the other one being leaps. But Novo Nordisk, as we alluded to at the beginning, took a huge dive this morning, and potentially a unwarranted dive. They said that there's more competition happening with Wegovy, so they took their 2025 sales growth forecast from 13 to 21% down to 8 to 14%. A 30% dive, I don't know that that's necessarily justified purely based on that adjustment, because we're talking about sales growth numbers. We're not talking about revenue or something. This is growth. This is new. This has nothing to do with the fundamentals of the company. Competition is definitely increasing for Wegovy, but the demand isn't going anywhere. I think I've said it on air before. America is only getting lonelier and fatter. I like any companies that rectify those 2 things. Like I said, fundamentals are still very strong. They have earnings coming up on August 6th, and I really like, this is an opportunity that I really like and rarely get, and you were able to kind of do it with Delta Airlines or United Airlines off of Delta Airlines earlier, but it's when the big negative thing or positive thing comes out in advance of the earnings call. So now we've all of a sudden done all this to price in this terrible information. I have a hard time seeing how anything could happen in that earnings call that forces us to 2 far lower lows. And it's been as high as $92 this calendar year, currently trading at $53.94 at today's close, as high as $133 in the last 365 days. Obviously, weight loss drug hype was propping it up a lot towards the end of 2024. I was about to say 2022, man. These years are really
They're all
rolling
bunching
by.
together at this point.
But yeah, it's been as high as $133 in the last 365 days. This is a 3-year low for the company in general, and it's just feels like a good buy spot for a company with great fundamentals that isn't going anywhere anytime soon. And also, I don't know why, but the market seems to have this perception now that these pharmaceutical companies are just weight loss companies, and I think that that's a thing that it kind of tends to happen with these pharmaceutical companies, because during COVID they were just vaccine companies. It was binary: do you have a vaccine or not? Your stock will move accordingly. And now it seems to be that way. Are you able to sell weight loss drugs or not? It's binary, and if you can't, your stock's going to tank. But are you telling me that Novo Nordisk has done no growing outside of Wegovy in the last 3 years? Like, it's crazy.
I mean, NVO's definitely taken a hit today. I mean, looking at the IV, it's out there. But I mean, today's taking it. NVO's taking a hit today. But if you look at the sell-off that I had a few weeks ago, IV spiked a lot higher than it did on the move today. And today felt really aggressive because it also dragged down one of my positions in Eli Lilly, like that we were mentioning a little bit, because they're kind of working off each other. They're competitors in the space.
Well, yeah, I mean, 30%, like
that's a hit.
UNH's CEO got shot and they only dropped 50%.
Right,
so we're talking about 30%? Like, yeah, it seems too crazy.
Speaking of United Healthcare too, I think we got United Healthcare earnings pretty soon.
Yes.
So that's going to be very
next week.
Yeah.
But yes, very
a lot
soon.
of eyes on that one. With that being said, NVO risk of the week. I like that. I'm also going to be keeping an eye on NVO as well.
Leaps. I don't have any crazy time horizon on this. The top leap that's listed, that's mainly a gamma play. If we even get like a $20 upswing, all of a sudden that premium is going to go through the roof. And the shares, I'm holding for a little while. I think that I don't know, 70, 80, 90 is in the equation in the next year or so.
When it comes to the weight loss drugs, it almost feels like, is this just a bubble? Is it this or that? But those weight loss drugs, or that industry as a whole, has like a cycle of like every 5-year or 10-year increment. It's true. Periods where you see some new supplements, some new gear, something within the fitness space. And to the point you made earlier, it's going to be an industry that's going to be profitable and around for as long as we live.
Yeah, and the analogy that I have continued to draw this entire time is that these weight loss drugs are like the AI of pharmaceuticals. You say semaglutide, you say GLP-1, and your stock goes up, and nobody asks any questions.
Pretty much.
And so, and much like the way I question AI in the tech space, not the future of AI. I agree it's the future, but just the way that these companies are able to do little tiny AI integrations and get share price bumps off of it. I also think that perhaps the share price bumps that people get when they roll out a weight loss drug is unjustified. It just happened to Hims because they rolled out generic semaglutide a week or two ago. But yeah, it's very interesting, and it very well could be a bubble. And also, I mean, people. There's always going to be some people that need help with weight loss, but this is a rare drug that kind of eradicates the need for itself. I mean, that's true as well with, I'm sure there was a medicine to treat cholera at some point that we don't really need anymore. But generally, the pharmaceutical industry likes to operate on a keep you for life sort of model. And this is one where you just do a treatment and then you're good.
See what we get with this healthcare industry, fitness. A lot of volatility. That's why it's risk of the week. That's why we're putting these positions on too. A lot of volatility. Mine, I know. It might seem a little lackluster. We can go ahead and jump to the next slide here. It seems lackluster, guys, but hear me out. Yes, I'm trading SPY right now. SPY was what I chose for the week. I sold it at a money cost spread, wanted to get on some negative delta. But I mean, we're 5 consecutive green weeks to the upside, and an upwards drifting market that has a history of returning 8 to 12%, something within that range on a year-to-year basis. So that's my justification for having this in risk of the week, kind of getting ahead on the short side. This one is a little bit further out in time. Sold this in the September cycle, so I'm not trying to time it too much. Just I believe that we're a little bit overbought at these levels. Things are feeling a little bit overcrowded. Things are extremely optimistic at these levels, and I know after we put in all-time highs, I know what the data says. But we're going to be selling an out-of-the-money call spread on SPY. We're going to be collecting just about a third of the width tomorrow. We're going to send it through tomorrow. I was checking out the chain today. It's only about $1.80 something for these strikes right now, but I'm going 50 something days out in time. So it's nice to be able to collect at least $2 to minimize that risk and have $3 left to risk, but we'll see if we get that. That's what I'm eyeing SPY. Go ahead, call me a boomer. I don't care. I'm going to accept it at this point. I'm not trading bonds yet, though.
I'm definitely for it. I mean, complacency is definitely at highs right now. Everybody just keeps buying, and we keep expecting this market to only go up. Breathing periods are natural and to be expected. You got solid strikes here to even give yourself a little bit more room should you need it. I'm with this. I'm seeing it. I do think it's perhaps a little boring.
But, it is a little boring.
But I'm with it.
I hear you. I think I can. That's valid. I like that take. But that's what we got for the week. We got Gus's NVO, SPY for me. We'll come back on Thursday, give an update on the positions, and go from there. But we do have some earnings.
Absolutely. Yeah. We got all kinds of earnings this week. Tech sector is going crazy. We have 4 companies in the Mag 7 going off this week. We're just going to run through these quick bullet points. We don't, earnings can get boring and get too far into the weeds. So let's dive right in. We can go next slide. Microsoft, first one. They report Wednesday, July 30th after the close. Consensus estimates outlined on screen here. EPS of $3.37, revenue of $73.8 billion. Obviously solid marks. We've also took the liberty of including a fun fact in each of these to keep everybody interested. So Bill Gates was arrested in New Mexico in 1977 for driving without a license and running a stop sign. Did you know that? Maybe you did. I realized after reading this that I had seen his mugshot before, but it had never clicked, or I thought that was some kind of promotional thing or something. Mm-hmm. But yeah, no, he really did get arrested. Sentiment-wise, they beat Q2. Are they not reporting Q2 earnings? Is this their Q3? I never know what fiscal years people are on. Anyway, beat estimates last quarter. Led double-digit growth in Azure Cloud and AI revenue. And all eyes will be on, never mind. I was going to say AWS. I'm getting ahead of myself here. They have Azure. Errol wasn't confirmed. Yes, but Microsoft coming up. They've been on quite the run-up to this point. It's interesting because right now, some of these stocks that you would consider to be I don't want to say boomer stocks, but like less exciting companies have been on some of the best runs.
As in what, like the blue chips?
Yeah, yeah, and even like IBM. Like I mentioned last week that this run that IBM is on, I can't believe it.
Yeah.
And yeah, that's a company that I feel like a lot of people had largely written off. So Microsoft been on an absolute tear. Like I said, I think it's going to take a lot to create any further upward momentum. But maybe they can do it. In this age of AI, you never know. People just pull money out of nowhere.
Right. Now, then this week, Wednesday, July 30th, we're going to have Meta earnings. EPS is going to be $5.88, revenue $44.8. Fun fact for Meta, the first item ever sold on Facebook Marketplace was a couch that the seller said reeked of cats in the description. Oh, so we got a little bit of customer feedback with the first use case of Meta there.
Yeah, yeah.
Also, do we want to add anything else on Microsoft before we jump right to Meta? We're good there?
I think we said our piece there.
Cool. But yeah, little fun fact there. Sentiment, Wall Street overwhelmingly positive on Meta's AI-heavy pivot. AI is not as much of a buzzword as it was 6 months ago. Analysts expect 5 to 6% post-earnings swing. Price targets between 750 and 800, given AI-driven and ad revenue growth. As you know, some of these price targets are very aggressive, are very optimistic. But I mean, on a personal sentiment, I believe in AI personally. Will we get to 750, 800? I mean, I hope we do. Will we? I have no clue. When will we get there? I don't know, but I do like Meta. I'm looking forward to the Meta earnings as well.
I think the same way. I mean, I certainly buy into AI, being the future. However, what I think is interesting with Meta right now is these insane like NFL style contracts that Mark Zuckerberg is handing out to anybody he can get his hands on pretty much right now. I mean, they're doing $100 million signing bonuses, $300 million contracts for these top level AI machine learning engineers. And, while it's obviously a very valuable thing, are you really telling me that there's going to be one employee that justifies $300 million? Like that seems a little bit extreme, but I think that a lot of things that Zuckerberg has done over the years would have seemed a little bit extreme at the time. I know he got called an idiot when he bought Instagram for $1 billion and said that was an overpay.
Yep.
So perhaps he's just willing to overpay for things that he knows are going to do well.
Yeah. And I mean, I think when you're in a position like that too, it's like you can afford to overpay for these things. It's like I can afford to take this loss too, so I can afford to speculate on this business, this company. I do super well with Facebook. It's crazy to think about that. He only bought it for $1 billion, Instagram. And it's not like Instagram was a very thriving product at the time.
Oh, no.
A lot of users.
It was an overpay. Everybody vilified him for it. It wasn't making, it made no money.
Right. And again, it was one of those things that you took pictures of whatever you thought. It was like for photographers. That's what it was geared towards. Anyways, cool to see what it develops into today. Because another thing I want to add on that piece before we shift gears is the photo dumps. Any other anybody unks or boomers that are not on Instagram, seeing the guys between 15 and 30, that age range, photo dumps are very common. And it's almost like these photo dumps are gravitating away from people just posting just selfies all the time, which that still happens. But I think it's so interesting how Instagram is going back to its first use case.
Yeah.
People were posting those photo dumps before. It's stuff they just thought was cool, or they seen an angle and they want to edit it and then post it. And it's like, I see people taking pictures of cool things again. And that's what originally Instagram was used for.
Well, yeah, it's sort of interesting pathing. And I know that like make Instagram casual has like been a push that people have been trying for the last couple of years. And it is slowly working. I do think that slow turnover is happening. And yeah, it's really interesting because Instagram came onto the scene and it was kind of like, this casual thing. Some people used it for nicer pictures or whatever. But I think what is really interesting in that whole calculus is Visco, which popped up, and that took the artsiness away from Instagram. And so I think that right there at the beginning, like 2012 to 15, those are kind of arbitrary years. But when Visco came around and began to gain popularity, that was when Instagram was at like peak casual, because you would go to Visco to post all your really good pictures, which is interesting to me.
I got you. Grumpy Mike's post selfies, hundreds and hundreds of them. And
Hell yeah.
We'll go back and spam those
Got
likes.
that.
What do we got? So next here on the slides, we've got QCOM. What do we got here?
Yeah, QCOM, they go off Wednesday, July 30th after the close. That's the last that will be going off after the close of this set on Wednesday the 30th. And consensus estimates are an EPS of $2.71, revenue of $10.3 billion. Qualcomm, sleeper, gigantic top 20 company in the world. Don't feel like it gets the media coverage of a top 20 company. But they've been around forever. And in the late 90s, they released the Global Star cell phone, which is the only cell phone ever created that could also function as a fax machine. The thing is insane. Guys, go Google a picture of this phone, please.
No.
Holy cow.
No.
It had like you had to put like a paper tray add-on if you wanted to use it as a fax machine, but it was like wide enough to just do it like gigantic.
Off the bat, is this practical? Can you see a use case for anybody in a very specific?
Absolutely not.
No,
I actually read that even in their internal reports, there was 4 people that ever used the fax functionality.
Is that because of cost? Difficult to get this piece of technology?
I mean,
or
yeah.
just not practical again?
I think just
all the
impractical.
above.
I mean, yeah, who's sending a fax from their cell phone? Like it just
no.
And then
I haven't heard that word in a while.
Scanners pop up right in there somewhere, and I'm not really seeing that. But it did exist. Go Google a global star and have a nice laugh. But yeah, Qualcomm, this one's going to be very important to me personally. I am incredibly long Qualcomm. But most pertinent right now is I have an August 15th 170 call that is naked. Closed at 162.08 today. So not exactly trying to ride that to in the money. I'm $18 in the green right now. So teetering very close to break even. And this earnings could absolutely tank that position for me if it does not go well. So go kill them, Qualcomm.
Kill him. Qualcomm was one of the risks of the week, was it not for you? If it wasn't for you, I think it might have been.
I probably have sometime.
Yeah,
I'm sure. I really like this company, and I really like them moving forward as well. They do Snapdragon, and I think it's all really good stuff. Whoever just isn't Hims just Viagra with snake oil? That made me laugh. No, Edward. I think that they do a lot more. Maybe at one point it was just Viagra.
So can you fax that to me?
Maybe at one point it was Viagra with snake oil, but these days, Hims is doing everything. Well, that's Hims and hers now. Yeah. They got. If you're losing it, they got it.
I feel like you can come up with a good slogan. If you're losing it, something.
It's true. If you're losing it, because I was about to say I was thinking about all the stuff they do. Yeah. I'm like, if you're losing hair, if you need to lose weight, if you're losing your ability in the bedroom, they
just slide that in on the third one. Not too soon, not too far at the bottom of the bullets. Slip that in there. Next, we have Apple this week, July 31st after the close. That's going to be on Thursday. EPS of 143, revenue 89.2 billion. Fun fact: the Apple co-founder Ronald Wayne sold his 10% stake in the company for $800, and then sold the contract he sold the stake with for $500 on eBay. That's tough to do something like that. It also just reminds me, like, sometimes in the beginning stages of things, sometimes you don't know you got a diamond on your hands. Yeah. I mean, just looking at some of those behaviors, Apple is one of those underlyings I've always enjoyed trading. Love the liquidity on Apple. Love the way Apple moves, just its overall personality. I've always been pro Apple. That's where I'm at on Apple. Not going to be trading Apple earnings. Definitely going to be interested to see what it's going to do. I'm always interested to see, what they're cooking up or what kind of random thing they want to drop for us, because things have been getting pretty redundant on the Apple side over here.
Yeah, we always talk about, Blockbuster passing on buying Netflix, and Yahoo passing on buying Google, and then passing on buying Google again. But this is the worst paper hands in the history of paper hands. $300 billion position. $300 billion position today, sold for $800. And then also, he sold the contract that he sold the stake with for $500 on eBay, and the person who bought it flipped it for $2,500.
I would have been sick.
Yeah.
Oh, I'd be sick.
Yeah.
Bro, I saw this video.
Ronald Wayne cannot catch a duck.
I saw this video, and they were just going out, starting with some money, and then buying and selling things to get some capital. And there was one, they did it in front of the person. They were like, "Oh, would you take 50 for it?" And they're like, "Oh, fine, I'll take 50." And then someone came by, and in front of them sells it for like 100, like a few seconds later. What do we got next here, guys?
Yeah, diving straight over to Amazon. Amazon goes off Thursday after the close, along with Apple. Consensus estimates call for an EPS of $1.33 per share, revenue of $162.2 billion. And fun fact here, Amazon acquired an entire social networking site called Evie in 2013 to poach one employee. They bought the whole company, they took one guy, and they shut it down. They did not care. So that's the links. I guess I'm talking about the links Zuckerberg will go to. That's the links that Bezos is willing to go to get who he wants. And the employee, unlike Zuckerberg,
that's crazy though, bro.
Some engineer or something. It was a voice actor. He really liked a voice actor, and so he bought the entire company to get the guy, which is hilarious because you're telling me. Logistically, this doesn't even make sense because you're telling me that you were able to buy the whole company. Why not just give the guy the offer and poach him out?
That's what I thought of right away.
I guess maybe there was a contract or something.
I've heard of things along those lines, like artists beefing with each other and then buying out the first 3 rows of their show.
Yes.
So it's empty in the front.
Yeah, I've absolutely seen that. Yeah, maybe there was a little bit of beef, but it seems like if you could afford the company, you could afford the guy. But I assume that he must have been contracted in for a few more years or whatever. But yeah, Bezos, that bald man don't play.
That ball man don't play. We'll see what we get. We'll see what kind of volatility we get out of Amazon heading into the rest of this week. We got the good old Berkshire Hathaway. Reports Thursday after the close, July 31st. EPS of 501, revenue of 91.9 billion. Little fun fact: Berkshire Hathaway started as a textile company in the 1960s, and Warren Buffett bought a controlling stake purely because he hated the management. What's up with these billion-dollar feuds?
I don't know.
I guess not.
Well,
in the
that's
past,
not
but I
even a
mean,
billion-dollar feud. Yeah, there was apparently they were a public company and they did a stock buyback that Buffett felt was unethical, and so he loaded up on enough shares to be able to control the company in that buyback because he was frustrated about it. And then after that, they turned it into a holdings company. So yeah,
being one of the big dogs.
Anyone have a Berkshire Hathaway textile in their closet? Grumpy Mike. That's right. That's right up your alley. You got a Berkshire Hathaway textile somewhere in your house?
Those guys just play a completely different game, huh?
Yeah.
Like apparently.
No, yeah. I mean, it's just, yeah, it's like next level thinking and betting on yourself craziness. But yeah, Berkshire Hathaway, obviously in an interesting spot. I believe this is their second earnings call since Warren Buffett has departed the company. And honestly, I mean, I like personally, Berkshire Hathaway to me just went away in my brain as soon as Warren Buffett.
Yeah, we haven't
left.
heard you bring it back up since he left.
No, and I loved it before. I would sit here and scream.
We'll take it off the watch list. That's how you know it's real.
I would sit here and shout. I would just say, give your money to Warren Buffett and wait 3 years, and good things are going to happen. You got the greatest investor of all time controlling your money, and much like any billion-dollar company, but I would even go as far as to say, like, much like Tesla. With Berkshire Hathaway, you were buying the man as much as you were buying the stock. And that is not the case anymore. I couldn't even tell you who's running Berkshire Hathaway these days. And I'm sure that they were trained amply by Warren Buffett and are going to do great things with the company. But it's just, I don't know, feels like there's other better directions to go these days.
Yeah, no, completely agree. We'll see what we get for some earnings this week. See how the risk and reward plays out this week. Manage some of those positions. Hope you guys are doing well. Tag us, add us if you get into any of these earnings that we went over this week. On Twitter, whatever the case might be. Anything else to add before we hop on out of here today, Gus?
Guess I don't have anything. What did we just talk about before we came on air that we were laughing about?
What was it? I know we said something. What was it exactly? It's
I don't remember.
Because you asked me. I'm blanking now.
Guys, it was really funny.
It was really funny. I was laughing right before we hopped on here. So hope everybody else is doing well. Manage those positions. We'll be back here on Thursday at 4:30 Central Time. See you guys next time. Peace.